Hello and welcome to the Property Trio podcast, the podcast for the sophisticated property buyer. And this week, it's market update. And a lot of the pundits are looking for the first signs in the data of the federal budget changes. And I think we can probably start pointing to some a little bit here. And to unpack all of that, it's my two friends, Kate Bakos and Dave Johnston. Hello.
Hello.
Good morning.
We have a bit of data here, don't we?
You're all business, Dave.
Well, the data's not amazing. Well, there's a lot in it, but it's not cheery.
No. And I think this is where maybe people come for a little bit more of a nuanced view than the media, because the whole media is talking about the national downturn. And if we take the month of June in isolation, indeed, across the board, we saw a 0.4% contraction, but still some resilience in the regions. The losses really led by Sydney and Melbourne. Everywhere else is either flat or up, apart from Canberra, which is back about 0.5%. But yeah, Sydney and Melbourne absolutely got hammered. So, Kate, we were talking at the PIPA conference and we had the head of research of Cotality there, and I asked the question, what's the data that we're looking for that will really tell the story? And they said, look, investor lending is the good one, but there's a huge lag with that particular data. So they're all frantically trying to find the smoking gun, because that's very good for media.
Yes.
So far, we've got this Cotality research and auction clearance rates, which have a little bit of a flaw. What do you think we can take from the data that we've got so far?
Well, you're absolutely right in saying that it only tells so much. It's like a jigsaw puzzle. You need all of the pieces and then you can really tell the story. So we always find that the lending data, the ABS-related data, it does have a lag, which is frustrating. Sentiment really helps us, and we get a snapshot of that on a monthly basis as well, a consumer sentiment index. But we can also have a look at some of the details around listing numbers, sale numbers, and the rate of change, distressed listings, new listings, total listings. And we'll delve into that because we've always talked about leading indicators on, markets that are cooling. Sometimes we can see the old listings start to increase, or when a market's really heating, those old listings disappear really quickly. So We've got a lot to delve into today, and the only data piece that we haven't got at our fingertips too really is the lending and also the consumer sentiment index. We're a week away from that. So we're going to promise our listeners that we'll unpack that a little bit next week when we cover a listener question.
And Dave, I mentioned sort of in the intro that 1 month doesn't make a trend, but indeed if we look at the quarterly change across the capitals, we're down 1.3%, sort of led by 3.2% declines in Sydney and 2.6% in Melbourne. So it's fair to say that's a fairly good trend that says there's some severe headwinds hitting those markets, would you say?
Yeah, look, I think we can probably extrapolate out and understand the trend that's on its way, and it's just not showing across. Well, the trend is that all the price of the cities that were accelerating are now decelerating. I suspect I would expect them all to move into some sort of negative territory over the next the back half of this year.
Yeah.
But I suspect that's already happening to some degree with many of the markets and sub-markets within those capital cities like Darwin and Perth, Brisbane and Adelaide. Adelaide for June was already at zero. It's already down to flat. Brisbane, this is according to Cotality, 0.3% only now with growth. Darwin's remained a bit of an outlier at 1.4%. Perth's, halved, if you like, from May, from 1.5 to 0.7, and it's a third of what the growth rate was in April of 2.1. March was 2.5%. So I think we're on a pathway to negative territory, which probably on the ground, if you're going to buy a property, you can probably get it for a bit less than you could have, 3 or 4 months ago, is I'd suspect in most markets.
It's interesting when I focus on my own local market, and as soon as the budget hit, I was just picking low-hanging fruit, high quality fruit, grabbing it for good prices. And then it just started to get a little bit harder. 3 weeks in, I had more competition. And then even last week, we had a couple of negotiations and missed out. So it's not like it was at the very beginning. And you tend to find this with shocks. I just question the data, how much of the time delay is really impacting the data and the rate of falls. We've always said that there's a bit of a lag, and I'm not for a minute suggesting the market's better. It's not. But the problem we've got now is vendors who don't have to sell aren't selling. So we've seen a lot of stock, contracted, but I've been chatting to the agents as well. They've had a large number of investors express that they want to sell, and they've issued their 90-day notices to their renters because they will be selling in September, October. So I'm fearful that we'll see, a large amount of stock come on in spring, with a lot of investors who are saying, let's exit the market and get our 50% capital gains tax discount. And that will certainly impact supply and demand unless we see a recovery in, the feelings and the spirit of the buyers, and they jump back in and take advantage of more listings and a market that's not flying. Unless we see that, we might see further price falls, because if the buyers are all standing on the sidelines and the vendors are in the market and wanting to sell, that supply demand imbalance will create issues.
A thought experiment maybe for you, Dave, and Kate, if you wanted to weigh in. If we look at the history of downturns in Australia, we don't really exceed 8-odd%. And
Yes.
I think psychologically, people are less likely to sell when they feel like it's not the right time. There's a big loss aversion sort of bias to people. I think if people are in a position where they need to sell, of course that happens. But if they're not, they will sort of hold on. So that will flow through to listings, and that will create some degree of resilience, I think. So it just kind of begs the question, are we going to see a downturn and then it's back to business, or will we see a protracted period of soft results?
Look, that's the $1 million question, Mike.
Making it hard for you. Crystal ball, question 3.
All right, here's the crystal ball. Look, I mean, that's the $1 million question. How long does any downturn last for? So what you start looking for, as a forward-looking, property analyst, is what are the metrics that could cause for the market to hit the bottom and to start to rebound, and I think, some of those metrics that you want to be looking for as an investor, for example, are yields hitting a certain level where they become, really, really high relative to historical norms. And obviously it makes the price point much more affordable, and the markets where those yields are higher and more inviting for investors. Obviously, as we get closer to the potential, if it in fact heads this way, of there being a rate reduction at some point. Now, obviously, inflation needs to come under control, but the money markets are now only betting a 20% chance of another rate rise this year. So, and then there's, many people predicting a rate reduction in the back half of next year. So I think, that those types of metrics are, along with people, certainly people choosing not to sell because they, like you said, that absolutely happens. Look, I really don't want to sell while the market's going so poorly. So people who can afford to will hold off.
Yeah.
That said, a falling market's a great time for an upgrader to look to sell and buy, because assuming they're paying more for the upgraded property, therefore the saving benefit is greater. So, look, I'm not going to necessarily. Well, I mean, look, if I was going to estimate when the market could start to turn,
Now we're talking.
I'll put a stake in the ground.
Good.
I'll say the second quarter of next year.
And on that stake in the ground stuff, Kate, we recorded in January with our 2026 predictions, and you rightly said they're all broken, but it's not really our fault. I mean, parts of it might be, but because we were going into an environment where Labor had said that they weren't touching this. So, like
50 times apparently.
Yeah, 54. And if you're driving around Copacabana, you'll see the 50 speed limit things with Anthony Albanese's face and a little lies under the 50, which is interesting. Send us a photo if you are spotting one of those. I'd love to see that. But yeah, those predictions are sort of gone in the bin, and we were talking off air about, okay, well, maybe it's worth just forecasting what we actually think will happen for the next 6 months, because it completely changes the game, right?
Yeah, it does. Look, it's a tough question, Mike. We have a bit of fun with our predictions, but we certainly explain that is what it's about. You know, we're having an educated guess on the balance of the information that we've got at hand. And a Prime Minister promising 50 times that something won't happen, you would think is a piece of fact that you can rely on. And it just goes to show that, you know, a political agenda and, you know, a leader that's happy to lie to the people will change the landscape completely and catch a lot of people off guard. I pride myself on being pretty across a lot of what's going on in our industry, and all three of us didn't predict this. We didn't even have it as a disclaimer. We had other threats and other challenges that our market was contending with, but not negative gearing being adopted, not even taken to the next election. So I'm really loath to say what I predict, because I'm sitting here in Melbourne and we've got a state election in November. Hasn't been much information rolling around at all, considering it's literally 4 months away. The only thing that the Allen government's started to do is give us a few free kicks. They've rebated our car registration and they've slashed public transport by 50%. So, you know, a couple of nice little Easter eggs there to sweeten the deal, but we don't know what's going to happen.
Yeah, but I think also what it highlights is that predictions over 12 months are more fraught. Predictions over 5 years or longer, you can be more certain because of market cycles. And, you know, that feeds into why we say to have a long-term strategy when you're looking to buy property. You know, like with Perth, during COVID, and it was the weakest performer, but it had protection. People couldn't go into the state. You know, I think for a couple of years I predicted it would have a really strong rebound, and then I gave up just as it did have the strong rebound because I was predicting too early before it actually happened. And even with negative gearing being at risk, that's something I shared in a recent episode that I've been talking with our clients about and spoken about on this episode as being a risk of being abolished. And I've been talking about that for probably 7 to 10 years. It's now happened. I didn't predict it though in our episode predictions in December, but it's something that I've thought was likely to play out with the trajectory I saw of what was happening in politics, and also this perception of inequality of wealth from the baby boomers versus current generations. So, you know, there's like real macro perspectives, and then there's, you know, really a 12-month prediction is a much more hit and miss type of thing. And that also says to our listeners, again, if you have that long-term view and plan, you know, you there's less risk. It's easier to ride out as long as you set yourself up the right way with, you know, your buffers of cash flow and available funds. And it's the same old boring meat and potato stuff, but it's the things that sometimes we can forget when we're making decisions, and we tend to think more short term.
Yeah.
There was, and on that sort of structural issue, we know sort of broadly speaking that in the last 20 years, house prices have doubled, yet debt has tripled. and there was a research report by Terry Rawnsley from KPMG that sort of put to bed this argument that, like you guys don't know, like it was 17% interest rates. It was a lot higher, but in the analysis that they did, they sort of equated the fact that, well, just because of those increased debt levels due to the house prices, it is actually a higher percentage of household income that's going to service a mortgage on a property than it was back in 17% interest rates. So we do have a structural problem. Housing is expensive. Unaffordable is a term that a lot of people argue about, but there's a strong argument to say something needed to be done. And I thought that thing was 1.2 million homes in 5 years, but they missed that, gave up on it, and they've done this. So, like, how do you guys process it?
Well, look, just on that, I'd say you can also make the argument, like with most things for the other way, say, look, the reason the property market has grown much faster is it's much easier to get finance than it ever used to be. You can 30-year loan terms, interest only is easier. You have help from the government to get into your first property. You have less stamp duty you need to pay. You can borrow 95% and you don't even barely need to save anything. So it's much easier to get into the property market. It's much easier to get finance. That's why we have more finance. It's actually the ease of access to finance that pushes up property prices. So, versus once upon a time, 25-year loan terms, not as many lenders that you could get access to. You didn't have brokers helping you out, providing 70% of loans. Like, these are real. This is the reality. Like, I think, the ease of access to finance is what's pushing up prices, along with overseas money, because Australia is a destination country. So, like you can make an argument for different perspectives, and ultimately they're just different economic realities in essence. What is the right economic reality? There is none, because they're all made up by a combination of politicians, voters, and who is able to influence policy.
Yeah, a very, very good point. Let's, we've got lots more to unpack on these structural changes, but let's get back onto the script. Kate, when you're looking at the change in dwelling values in the past sort of 3 months, 12 months, what are the standouts amongst some of the capitals and the regions that have sort of surprised you in the last little while?
Look, the regions are still overall nationally positive. Combined capitals for the month were down 0.6%, for the quarter 1.3%, annually up 6.1%. So we've seen everything flying in that. Brisbane, Adelaide, Perth, Darwin, they've done really well. Darwin this month has been very resilient. 1.4% for that market. I would argue that that's still showing that Darwin is experiencing strong demand. Poor Melbourne, I'm looking at Melbourne's median value, and I know that we have a lot more units, but at 808, that just feels pretty grim. It's the third cheapest capital city on the list there. If I am going to predict anything, I do wonder how the regions are going to fare, because we know that they've been supported by a lot of investment activity, a lot of investor activity. So I've maintained that I think Perth and Darwin will come off, because particularly Darwin, it's a small size market. It's not much bigger than Ballarat when we look at the size of the city. But I think regions as well, we need to keep an eye on that. If I'm predicting anything, it would be in the next 6 months. I think we'll see the regional overall growth rate, not just slow, but it might hit zero or go into negative.
Yeah, I think that's a fair hypothesis. Dave, if we look at the rents chart, certainly for houses, we went through a pretty rapid pace of growth, and it sort of seemed like it took a little bit of a breather, but it looks like during that breather it also took some performance-enhancing drugs and a fair whack of caffeine. This 2%, this $2 a week Treasury modelling of rents going up was always questionable, but like how long before we say, well, that was an absolute furphy? Because as Kate mentions, with investors that are exiting the market, it's it's only going to get worse because the incentive to purchase a property as an investor is just not there anymore unless it's the new builds.
Yeah, well, I think the three of us probably called it a furphy right from the start. And, it's only early days. The last couple months, national rental index was 0.5% seasonally adjusted for June, and so that annualized is 6%, and the actual annual rental growth nationally for the last 12 months is 5.9%. So obviously that's a fair way, significantly above inflation. Inflation is sitting, somewhere in the sort of high threes, maybe low fours, and obviously income growth is around 3% or so. So this is just getting more and more expensive for anyone who's renting, and I actually think this is going to accelerate with the changes they've brought in. So I'm really interested to see how this plays out because we've dedicated episodes. You need to tackle supply, and the tax changes are not really helping supply. Certainly in the initial years, but also Treasury's modelling to go, to support what the changes they're making said it's not going to increase supply.
Yeah.
Yeah,
I concur. I look at this chart and houses are messy and they're just going to get messier in terms of rising rents. Every single line on this is pointing up. Units are a bit more fragmented, and that's got a lot to do with new builds and the blend of units versus houses in any given capital city. But we are going to continue losing a lot of houses from our rental pool as investors cash in or get their 50% discount or just leave the market, particularly those that are fed up with some of the rental-based legislation changes.
Look, I was just going to say, like the real issue is vacancy rates, and vacancy rates are still at 1.6% according to Cotality, well below the decade average of 2.5%. But if you look at the average for the 5 years prior to COVID, it was 3.3%, and I'm pretty sure the previous decade was 3.5% average. So, really since the cost of building went up significantly over COVID, we just, we haven't been able to catch up. It's become less affordable or profitable to build new properties, and the government haven't done enough to help in this space. And so vacancy rates keep going down, and that means rents keep going up. And these, disincentivizing people to buy investment properties is only going to escalate that.
Yes.
And I think construction feasibilities are likely to get worse as if we do go into a national downturn. I mean, there's certain markets like Perth, for example, where the price of established is so high that it stacks a little bit more. But in places like Sydney and Melbourne, those markets continue to decline. The feasibility on a new build, given construction costs aren't going down, and we've seen about a 34% increase since the beginning of COVID in construction costs, which is mostly a labour problem these days after the initial material problems. It's not getting any better soon. And one thing that we have all kind of flagged is that it's likely that we will see a little bit of a downturn in prices, but there's nothing that says rents are going to subtract. And it's a little bit early to see, but a little bit of a hockey stick shape in the gross rental yields for dwellings, especially across the capitals. Kate, too early to call, or is that the sign of an uphill sort of trend?
No, it's not too early to call. We've had consecutive months. We're not looking at 2 or 3 data points here. It's definitely well above the target inflation band, and yeah, it's a hockey stick, Mike.
Yeah, and that's going to keep going up. It's my prediction there. And I think I said in one of the apps, I thought yields had the potential to increase by up to 2% over this period of transition. So I think that's going to keep rising. And you look at Melbourne and what I was talking about before, when yields become like too enticing for investors not to go, hang on, this is a
Yes.
market to get into. Like, look
You've
at
touched
Melbourne.
on something,
Yeah.
Dave. I am still getting investor inquiry. It's different. I've got that mad rush of SMSF investors who want to buy before the 9th of August. But I've had some investors who are looking to spend around 550, 600,000 on a 2-bedroom apartment in an inner area, and they're circling 5.5% gross rental yields. And
Yeah.
at first I thought, that's a little bit of an unrealistic expectation. But when you run the ruler over them, many of them are above 5, and I haven't seen that for a long, long time.
Yeah, and those rents are going to keep rising. And I did say this in one of these early episodes once the budget fell. Proportionally, as that rent keeps going up relative to the price you paid, I think within 1 to 2 years, that yield will go from 5 and 5.5 for that actual buyer to be like 6-7% pretty quickly relative to the price they paid.
Yeah, I
And then if
agree.
we do see interest rates reduce next year, then the net returns become more attractive. And isn't it funny how free market economics sort of tends to rebalance, right? If we get to a point where we're getting, solid gross yields at 7%, then that's going to move on the prices as well. But I'm interested in your thoughts, Kate, on those particular examples. If we're talking 500-600K, and I'm guessing that these are, the older style established apartments in tightly held areas. What do you feel like their prospect for capital growth is over the next sort of 5 years?
Yeah, they want to watch. They've been moving, I won't say aggressively, but steadily for the last couple of years. And we've got to be really specific here. We're talking about properties without lifts, and ideally, no more than 20 apartments, ideally less than 12. And they're usually 2-story boutique blocks in a street where it's mostly period houses and you've got really high amenity. Everyone's got a car space. The property definitely has to be nice internally to pull over 5%. If it's original or it's a really old dated renovation, it won't get the 5%. But I'm definitely seeing a bit of price pressure there, and not just because of investor activity and investors pivoting to higher yielding properties, because after COVID, we saw a lot of people wanting to return to the city. And we all know that something under 50 square metres is a little harder to finance. I'm not a fan of a dwelling that's less than 50 square metres. I think it leaves the owner a bit vulnerable to the effects of that in relation to lending policy and resale ability. But yeah, we've also seen young people targeting 2-bedders, maybe because they work from home and they have an office, or maybe because they want the option to have a renter move in with them and help with the bills. So yeah, I've definitely seen a bit of a shift, Mike.
And for those playing at home that maybe the size in square meters doesn't mean a huge amount to them, like typically a double garage is 6x6, which is about 36 square meters. So like 50 square meters, we're not talking much bigger than that. We're talking about maybe a 3-car garage as the whole living space for kitchen, dining, bathroom and sleeping. So it is a fairly pokey little place.
Yeah, it's tight.
All right, so it's a good upgrader market. It's good if you're a baby boomer and you've made $1 squillion and you want to lock in your 50% CGT to sell. But for anyone else, what does the listings data say around people's idea of it's a good time to get out?
Well, look, I think if we look, total listings are up relative to 12 months ago in all capital cities, according to SQM, except for Perth and Darwin and Hobart. But I think they're on the trajectory to end up in positive territory. Now, this isn't necessarily because new listings are flying, although they are increasing in most states, or most capital cities, actually, other than just Sydney and Hobart. But it's also because there's not as many buyers. So properties are sitting on the market for longer. So we have more of a long tail, if you like, of properties that aren't being purchased. But so I think, new listings is really interesting. Darwin is up 33%. from 12 months ago. So it's on the cusp of, flattening out, I suspect, and probably going backwards. I would imagine there are a lot of people who have owned in Darwin and Perth over the previous, 10 to 15 years who are starting to get deja vu and feel a bit fearful about what might play out over the next few years. Those who've owned and had the lived experience of a market that's gone backwards previously over a decade or longer. And so some of them will be seriously considering getting out of the market now. Yeah, so there's definitely a jump in listings now. Some of that is off a really low base, so we should be mindful of that because people were holding on to property last year in those cities that were flying, which Darwin, Brisbane, Adelaide, Perth. But there's clearly an upward spike in total listings and new listings, pretty much, across the board in new listings. And I think total listings are going to get there with all the capital cities as well.
Looks like we called the bottom of Hobart pretty well too, Dave. So with that tailwind behind
it's the only one really holding. Yeah.
I'm wondering now, is it the
Hobart's
time to
doing
call
right.
the top of Darwin?
Yes. Yep, I'll call it.
You heard it here first. Okay, so there's some data that we have on asking prices as well, which is telling an interesting story. Do you want to take the lead on that one?
Yeah, sure. So when you're in a changing market, I like to look at the asking prices because SQM provide these weekly asking prices and then change on the rolling month. It gives us a more now insight. And I know it's not what they sold for, but people tend to adjust first with their asking prices. So what we see, in the change in the rolling month, Sydney and Melbourne, all houses, all units and all combined, plus Brisbane of the rolling month are all in negative territory. Perth, you can see initially it's the all units. Same with Adelaide are in negative territory. And then Darwin, we've got all houses and all combined in negative territory. Hobart is now feeling a bit of that with all houses and all combined negative for the last month. So, I think Canberra is the only one with the asking prices that hasn't gone in negative territory. They're all slightly up, rolling the last month. So I just think that it gives us a pretty early indicator, leading indicator with the asking prices.
Canberra fascinated me. I would have thought that these vendors would be adjusting to the market conditions. And, Canberra hasn't been doing well at all. It demonstrated really poor growth, negative growth this particular month. Are their vendors resistant to price changes? What's going on there?
Yeah, I don't know, to be honest. I mean, because maybe it's just they took a bit longer to move. All the public servants, they held on for a little bit longer because the weekly changes, all three are negative, but the rolling month they're up. So perhaps that's just about to hit, like all the other capital cities have.
Yeah, I did wonder.
Well, there's still a lot to come, and I'm very interested in the investor lending stuff. Of course, that was something that we were looking at, but when Cotality are flagging that as sort of the number one indicator, that makes it very interesting. When can we expect, do you think, Dave, to see investor lending data come through that will be telling a story?
Yeah, I think it's due to come out next month. So next release is the 14th of August. So maybe next month's episode we do just after the 14th of August and get that data. Look, I've started tracking this within our own business. So because I just want to see what's happening with us. It's also to understand your own business and where, your risks lie as well. But if I look at us as a business, so for 2025, we had 1/3 of our business for finance was purchases. It was 37% purchases, 63% refinances. And so at this stage of this year, the purchases have come down to about 30%, refis up at 70%. But I think that's going to come down further, obviously now post these tax changes. So I'll start looking at some actual recent months. Now that has a lag effect, and obviously lodgements would be even more, I guess, up to date to look at how those numbers are changing. So just started with this data over the last 18 months. But then if we look at purchase breakdown, so in with actual purchases, we were 40% investment. We have been 40% investment this year, 60% owner occupier. Last year we were 48% investment, 52% owner occupier. So that's already dropped down 8%, but I suspect that number's going to go down a fair bit further. So I'll start tracking that more closely as well and just seeing what's happening on the ground with us, because I think, those investment financing purchase numbers are going to keep falling lower, and I assume we'll see that in the national stats as well.
Yeah, that's interesting.
That's one we haven't really seen since May, and of course the sentiment, we're only really looking at that sort of coming online in, I think, the 14th of July. So those are a couple of really big ones to look at, Kate, in the next little while. That should tell a really interesting story.
Yeah, agreed. Absolutely agreed.
Well, we are waiting for a little bit of data, but we did decide to pull the trigger on the market update a little bit earlier because of that headline figure. The media is obviously jumping on the national downturn, but of course, stick with us and we will guide you through all the data and what it means for you. For you guys, what else is there that you've observed, whether it's conversations? I know, Kate, you've been meeting with shadow housing ministers. Dave, obviously, you've have lots of conversations with your clients. You're plugged into their sentiment, and Kate, of course, as a buyer's agent, you're much more coal-faced than the data. What do we take away? What's happening? What are people feeling? I know even owner occupiers were sitting on the sidelines for a period because, it kind of begs the question, what? Nothing's really changed for them, but there's still a degree of uncertainty.
The news breaking of the budget changes, that was the biggest shock in terms of market shock and buyer reaction. Once Chalmers announced the proposed legislative changes, people really did get uncomfortable, and we saw a real freeze in buyer activity, and we saw some very motivated, desperate vendors who had probably already started their campaigns, and all of a sudden they're facing these headwinds. And people were telling me, I'm waiting to see what happens, what's legislated. So that was really interesting. And once it did get legislated, I felt more than a subtle shift. So I think that we'll see buyers returning, but what we have to factor in is first home buyers are notoriously nervous. They always have been. So the cohort that the government think this is helping, they're not really taking advantage of it yet. They're standing back thinking, oh, maybe I should wait. And, just anecdotally, I got a ride back from the airport yesterday and my Uber driver wanted to talk about the housing market. And I thought, okay, here we go. He didn't know that I work in the housing market. And he said he'd sold his house in Ballarat and was wanting to move to Melbourne, and he was really disappointed with the cost of housing in Melbourne and the apparent differential that he's going to have to cover to do that switch, which makes sense. And he said to me, my sister knows someone who's in the property industry and they said the market's going to collapse, so we are going to rent for a year and then buy. And I said to him, be really careful about that strategy, because if it doesn't collapse and if it strengthens, you're in trouble. So you've got to remind yourself, if you're trading in a market, if your conditions are horrible on both sides of the equation, what you know is that you're trading in a market that's got the same forces on either side of each transaction. So you might take a hit with your sale, but you're taking a hit on the price that you'll pay, and vice versa. If you haven't got the luxury to try and time the market and get it wrong, I don't think you should.
Isn't that interesting that like there's a third party with one degree of separation that has a view, and then they're making a decision based on that, which if they get right or wrong, like it's not overstating it to say this could be a $50 or $100,000 decision to their detriment. Like I know Dave is always talking about, strategic advice. Yet there's some people that just maybe, I suppose that it has to be a bias. That person must think that it's going to crash. They look for anyone that sort of corroborates that and like, oh, they're within the industry, so they're locking in that decision. But people shouldn't be making decisions that have such a huge financial upside or downside based on the anecdotal advice of somebody who maybe is somewhat of a mystery to them. Am I the only one that finds that bizarre?
No, not at all. I got bizarre or troubling.
But common.
Very common.
Yeah.
Look at all the people that decided to wait and see. Let's see what happens when COVID broke and lockdown started. And what happened to them? They got left behind. The market did surge. I'm not suggesting that this market's about to surge. I don't think it will. But I think over the space of a year, we could see a recovery. And if you've sold in the depths of the market and then you're waiting for change and then it starts to fly, you'll miss your place. You'll miss that step on the ladder.
And rents could fly at the same time. And so you could find yourself on a 6-month lease that you get a very meaningful increase, not $2 a week.
Yeah. And I mean, like people want information that's really simple to digest, bite-sized, Twitter type, market's going to crash. I make decision to sell, I rent, then I buy, I win. That's sort of the summary of that his take, that you can say in 2 to 4 sentences. But okay, right. So what's the risk with having sold then? What were your loan repayments? How much rent are you going to have to pay for 12 months? How have you factored that into the financial outcome? What happens if prices rise? What's your borrowing capacity? How might that change over the next 12 months? Like to actually work through it properly, that takes time and effort. And, that's multiple hours of conversation and analysis. Like good luck doing it by yourself. But, if you're smart enough, you'll have, 1 or 2 strategic advisors who will help you work through that. But that's probably 1 to 2 hours of communication, face-to-face, emails, sourcing data. Let's add another half an hour of information of, you getting your own information. Let's probably call it an hour. And then whoever you're working with spending 2 to 4 hours. Like, to actually analyze that properly, you're looking at probably a minimum of 4 to 8 hours of analysis. Now, how has this person, do most people do this? When they're making those decisions? Probably a lot of people don't. It sounds like this person hasn't. Because often we want to feel like we know the answer, but we don't want to have to put too much effort into it.
Yeah. It always baffles me that people will make big, big decisions quickly with not very much information. And then you contrast that with the time that you spend on an international trip.
Yeah. Or your updated TV. I don't think any of us believe that the market is going to crash. It begs the question, what is a crash? I think for argument's sake, let's say a crash would be 20 or 30%. Even 10% would be unusual, unprecedented,
very large,
in modern Australian history. It sort of makes you think, like, what does a crash mean to them? Are they talking about 50%? Well, people have to sell at a loss for that to happen, and people hate doing that, and they're going to avoid that every way that they can. But Kate, I wanted to ask you quickly, just before we finish up, you talk about cautious first home buyers. Now, if you bought, I know you can't do this, but if you bought a median priced house as a first home buyer 3 months ago, you are down 3.2% for the quarter. Last month, we saw 1.2% decrease. If that does that 2 more times, there's a magical term that we'll start hearing more and more called negative equity.
Negative equity.
Equity, yeah. Do you think first home buyers fully understand that, and do you think that will be a story that will dominate the headlines for the back end of this year?
Yeah, it's already starting. There's certainly that term was thrown around a lot in yesterday's meeting with the shadow housing minister. And I want to caution first home buyers to understand it so that they're not freaking out. Negative equity means that your house is worth, or your property is worth less than the debt that you've got against it, which is not a nice feeling, but that's today. So unless you sell and then crystallize that loss, it's just academic. And so when we purchase property, it's for a long-term decision. It's either because you're looking to future-proof yourself in a home that you'll enjoy for a long time, or it's an investment that should always be a long-term decision. And negative equity is a horrible thought, but anyone who purchases on a 95 or greater LVR risks this. That is why there's mortgage insurance in place above 80%. It's because it's a risky level of borrowing compared to the debt that you're carrying.
Yeah. Look, I think, and again, I touched on this, I think, in probably our first episode after the day after the budget, but I think this is sort of the canary in the coal mine politically, but it's going to be a slow moving, car crash type thing as the property prices flatten out, fall, and that data comes through more clearly. And then there's this huge cohort of first home buyers who the government have made it easier than ever, and then they've enticed them, they've given them money, they've reduced their stamp duty to get into the market at record numbers in the last 12 to 18 months.
Yes.
Now, the government have changed this legislation and are putting them in negative equity. And that is going to become noisier and noisier in the media. And I think it's going to have probably the biggest political backlash possibly of anything else that's going to happen between now and whenever they choose to call the election. And I also think it's probably the highest possibility of causing Labor itself to repeal some of what they've done. But, I'm not holding my breath for that. But this is going to be big news.
Well, we'll be watching it, as we will all the other data points, and unpacking that for you guys in our market updates. And Dave has got something for the buzzer.
There's one last thing I just wanted to share, which is PropTrack's data. Because I think often when we've got these changing markets, you've got a more simplistic calculation of median prices. It has every single capital city going backwards in the last month, the month of June, except for Darwin. And Darwin, it only had rising 0.2%. So I think it's more likely to be accurate, and that's more likely to what's going on. In fact, I think, this is worthwhile, I think, sharing. It has Adelaide backwards in the last month, Hobart backwards, Brisbane only 0.2, those three. It actually has Perth as the highest falling capital city, along with Sydney, over the last month at 0.5. And it's had Perth falling in the last 2 months. So, I think particularly, like we always talk about cotality, and I think it has the most robust, way of calculating median values. But particularly when you're going through a changing market, some of these more simplified versions give you the information quicker, I think, of what's happening. So I just wanted to share that PropTrack, which is REA's, index. Every single capital city has gone backwards in the last month in June, according to it, except for Darwin. Yeah.
Very good point. And we're talking a 50 to 100%, 100 basis point differential, depending on the capital city or the market that you're looking at. And that's meaningful. And we are desperately sort of clawing at what data points we can speak to that tell the real story, because we are definitely in a state of flux. So we look forward to bringing that to you guys in the next little while. We've also got some great listener questions coming up. So thank you guys for a ripping market update.
Thanks, guys. Thanks for guiding us. through it as always, Mike, with your fantastic off-the-cuff questions.
Crystal
Very
ball
good.
and pocket at
Look
all
forward to
times,
getting the
mate.
rest of the data.
Yes, absolutely. We'll see you guys next week.
See you next week.
See you next week.